Hi, William Sheriff here, Executive Chairman of enCore Energy Corp., America's clean energy company. We're devoted 100% to in-situ recovery of uranium in the United States, which is the world's largest consumer of uranium for the generation of electrical power.
Bill, good to see you, and thanks for joining us, especially on what's going to be a busy day for you, I suspect, telling people about the latest transaction. When he gives the highlights.
Thank you. Thanks, Matt. Thanks for having us. And yeah, I suspect it will be rather busy. We had worked, probably the better part of a year on getting the deal with the Alta Mesa joint venture with Boss Energy, certainly over 6 months. And it all came about back about 13 months ago. We picked up the Alta Mesa project from Energy Fuels. And that, just to refresh people's minds, was a $120 million purchase price. And half of that was in debt, half of it was in cash. We'd worked that debt down to $20 million through our ATM program at a premium price to the conversion on the note. So we issued far less shares. And shortly after the transaction, we were contacted by Boss looking for some sort of an arrangement, and not necessarily on that asset, but just contacted and doing business. So we kicked the tires, went back and forth for a while, obviously not in a heated discussion, but the pace picked up throughout the summer. And there were a number of various formats or ideas kicked around that we just, quite frankly, weren't interested in. We, as I say, we're quite focused on what we're doing and have a really solid pathway built out in front of us. And so we ended up in the format of a joint venture on Alta Mesa, which intrigued them, of course, because of its size. And being in a stable jurisdiction certainly intrigued us because it provided us the cash to be able to move forward on a number of fronts. Prior to that time, as you're probably aware, we've been living hand to mouth. That is a very linear track, getting just enough money to do the next project and move on, which when you have a portfolio of production projects such as we do, that's certainly not the most optimal route to go, especially given the uranium market that we're in and that we see coming. So we kicked the ball back and forth, 50-50, whatever. And at the end of the day, we were a bit of an impasse, and we went back, both sides scratched their head. We decided we needed $70 million, that number being the one that we'd actually calculated. It wasn't a random number. We actually calculated that as being what we need to take our portfolio of projects and move them ahead in parallel as opposed to in single file. And it does give away 30% of the Alta Mesa production, but in exchange for that, it really accelerates our build out on the pounds and in terms of the production. And we view it as similar or akin to an M&A transaction, and we've been very clear on M&A that any M&A we do will be quite constructive and accretive in terms of either pounds produced or the timing in which those pounds are produced. And this clearly enabled the time factor to advance significantly without really diminishing anything that we're going to see out of Alta Mesa this year or next, really. Just because it's once your plant's built, it's really a function of drill rigs and getting your plumbing installed until you max out that capacity. So by having extra money, we get extra drill rigs, can afford extra equipment, and bring in more well fields sooner, and max out that production capacity sooner by virtue of having that cash. So real benefit to us. It
was really interesting to me because when you picked that up from Energy Fuels, $120 million, as you said, it kind of felt like it was stretching you guys a bit. It was quite a punchy price line. But the deal that you've just done, obviously, you're bringing $70 million into the company to allow you to do what you want to do. So you've shown that you've I guess generated some value there, you could argue, because you're only giving away 30% of the Alta Mesa property, yeah?
Oh, that's right. I mean, the valuation based upon, half a year's time passing or even a year if you want to go to closing, increased the value of that 30% by well over 70%. And so, to be able to do that on a capital asset in 12 months is pretty phenomenal, I think.
Right, and the other part of the deal, which you've not talked about yet, is obviously the loan of £200,000. Now, that's physical uranium we're talking about, or is that balance sheet uranium? And what's it for?
No, it's physical. Boss Energy had maintained an inventory, obviously at the converter, not in their backyard necessarily. So that was book transferred, or will be able to be book transferred over to us at our election. And that essentially is to give us the ability, with our production, we certainly can meet our targets this year, but having that flexibility of the extra 200,000 pounds, as you're more than aware, the spot price is quite volatile. And we would really like the flexibility to be able to take advantage of short-term run-ups in that. And here again, we also have the ability to repay that in kind. So our production is not 100% sold forward into these contracts. So we have the ability to enter into novel agreements such as this to allow us a bit of flexibility early. That flexibility in our production will come a bit later. But during ramp up, you need every pound you can get. And so this is, it was just an added feature, if you will, of the transaction, one that we desired, just to give us that flexibility, and one that they were in a unique position, or virtually unique position, to be able to provide.
So I'd say that's the bit that interests me. You said it was like, it almost sounds like an afterthought, but I think it's a bit more than that, because you talk about flexibility and optionality for you with 200,000 pounds. There's a 9% coupon attached to that, right? So there is that, and it's repayable within 12 months. So that's kind of the broad structure of the deal. What does that allow you to do? Is it about having conversations with utilities and saying, well, actually, we've got something in the bank here. Certainly on the books at the moment, if you want to, but you won't necessarily take physical control and sell that physical unless there's spikes in the market. I mean, so are you playing the market, or are you trying to enable you to kind of get better deals on contracts?
Well, it's both, all of the above and one more. The one more aspect is oftentimes you have very good relationships with your counterparty. There's only so many people in the room in terms of buying and selling uranium. And oftentimes, if you're in a position to be able to help them out on the short term, here again, not by discounting the price or anything like that, but quite frankly, right now, it's just simply difficult to find uranium. And so if you have some and you can ease their pain a bit on the immediate front, then oftentimes you can see that gratitude expressed in the out terms or in a better contract, or it's just good business to help out your counterparties when you can. When they're over a barrel, I mean, everyone looks at, oh, this is really great. I've got the utility over the barrel here. There's no supply. I got a little bit in supply here. I can really get the best price out of them. But that's a pretty short-sighted vision. They're going to be your same customers you're going to have for the next 20 years. So probably a better approach is to try and keep both sides happy and try and work to help one another when you can. There are a number of various scenarios that might happen to any producer, such that they have a shortfall and they have deliveries they have to make. It might be nice to have that goodwill stocked up somewhere down the road as well. So it's a number of factors, but clearly we were incentivized by the number in terms of the current spot price, and having that flexibility to capitalize on what's a very profitable number for us. At time.
That's a fixed amount belt, right? That's not a case of a drawdown. The book transfer will happen. You'll have 200,000 pounds, $20 million worth of physical uranium, which you'll be paying 9% on from day one. I assume there's some deferment, unless you're going to go and raise some capital on that payment. Is it back ended or
no? But with over 70 million in the bank and a few other irons in the fire, we're not too worried about that. We are zero debt. We have been for probably a month now. And that last bit of debt that was outstanding was converted into shares of the company. So, we're easily able to handle a 9% on a $20 million fee. And the $20 million, while it'll be carried as an indebtedness, obviously intends to be repaid out of production. Right.
Okay. So you've explained what it does for you in terms of freeing up your balance sheet, tidying up your balance sheet, and giving you the capital you need to kind of move forward on a number of fronts. And one of your big goals is hit 3 million pounds of production. Let's just kind of remind people about, in terms of Alta Mesa, it sort of has produced an average from 2005 2013 of 0.57 million pounds. It has done as high as £1 million, and your license for 1.5 million pounds. So that's an integral part of what you're doing going forward. So how else do you deliver against that 3 million target? What else is going on out there?
First off, it's never really had the heat to the fire, if you will. It's never run at full capacity. The other issue is that it has a 2 million pound total licensed capacity when you include the dryer at the back end of the plant. So
Gotcha.
It's in an ideal situation to augment that 1.5 million pounds out of the existing well fields and out of future well fields on site, plus another 500,000 out of satellite deliveries from remote locations. And by remote, we can easily haul satellite feed, a couple 100 miles under current prices, 300, 400, even 500. Not that we would want to. There's abundance of opportunities within a couple 100 miles of the plant. So obviously satellite feed, but the emphasis there at Alta Mesa is going to be getting up to that 1.5 million pounds, of homegrown material, if you will, that's right on site. And here again, that's a significant portion of what the boss money is going to be doing. And in order to do that, it's not like we need to go out and find more uranium. We know where the uranium is. We have it. We have a resource of uranium. It's simply a matter of getting enough drill rigs. And drill rigs right now is a very tight commodity. And that's not true. I misspoke. Finding drill rigs is quite easy. Most of them are stacked up in the drillers' yards with no one to run them. And finding someone that wants to work on a drill rig and have a quality skilled group that's safely operating on a drill rig is what's in short supply. And these aren't fancy rigs. These are water well rigs, conventional run-of-the-mill watery rigs. We aren't talking core or reverse circulation or anything of the kind. But nonetheless, there's a lack of them, a tightness in supply. And we would love to be able to double or even conceivably triple the number of drill rigs that we have on site now. And that is the key to maximizing out the production and then taking advantage of that full plant capacity is the number of holes you drill. Then after that, it's surface plumbing, essentially.
Right. Okay. I want to come on to that because what I meant to ask you was about just on Boss Energy, right? So Boss Energy have taken the opportunity not only to do this deal with you, which kind of gives them a nice geographic picture that they've painted, Western Australia and obviously now in the US but they've taken the opportunity to go and raise an extra $215 million off the back of it. They're a $2 billion Aussie company and you're essentially a $1 billion company yourself. It's not quite of equals, but it's obviously done a lot for them. I mean, what did you think that they were going to get out of it? Did they get more out of it than they thought they would? Do you think it was a fair deal across the board?
I view it. When you evaluate these deals, I think you really have to walk away. A perfect deal is when both parties think, I could have done just a little bit better at the end of the day. No one truly has 100% insight of the other party's total package of objectives. I go back to when we first bought Alta Mesa. We were roundly criticized for having paid an extremely high dollar price for it and way too much. Yet, half a dozen months later, 70% premium on it, or 12 months later, over a 70% premium on the valuation metric. Looks like we did a pretty good deal. I spend all of my time worrying about what's good for enCore and what's good for enCore shareholders. And I never have been one of those that worried too much about, the other guy that they got too much or boy, we really got them. I never even view a transaction that way. It's entirely what's going to benefit enCore and enCore shareholders. If the other party prospers from it, that's great. They have different objectives than we do. And, fair enough. But the main thing is that we need to achieve our objectives. And I would say at this point, it's pretty clear our objectives and our evaluation metrics on Alta Mesa have exceeded our expectations. So, we're quite pleased, and to have built off of that first transaction by even owning, slightly less, even though we do get a management fee, which makes it a bit more effective than 70% on the bottom line. But nonetheless, that has given us power to move our entire portfolio ahead, not just that one project, which we would have been working on by itself for some time to come. That, or we would have had to go back to the equity markets to raise additional capital. And as you have already mentioned, we were quite busy in the markets last year raising the money to pay for Alta Mesa. So
let's just take a look. You said this conversation started six to 12 months ago in various shapes or forms and seriousness, etc. But here we are. The deal's closed. It's a very different market now. It's a very, very different market now. I think the bid is somewhere between 96 and 98 at the moment. So it's been over $100, and it's still hot. We've had a kind of a brief pause is where I'm going to call it. And I'm sure you'll tell me how you view these things as well. But I'm interested in the phrase which Boss used in their PowerPoint, which is about a strategic relationship being formed. In a market like this, how do you see the production side of things meeting demand? How do you see the North American or the Western supply side of that equation panning out? Because it feels like all we seem to see on social media is lots of exploration stories. The excitement, and I'm sure the build-up of the number of exploration stories that will be hitting the supermarket shelves soon is extraordinary. But how do you see this thing playing out?
Well, I think, especially after having been through the 04 to 08 little mini boom, everybody and their dog wants to be a producer, but the reality of it is, there's enough uranium for everyone to be a producer, but there certainly that's the smallest of the hurdles to become a producer. I would be highly skeptical over the next decade if we see more than 8 or 9 new producers in the world, much less in the United States. It's just timing doesn't allow for permitting timing, bringing along the talent to actually operate and successfully extract and market uranium. It's not quite the same game as copper or gold. So I would be highly surprised. And obviously, your margins are better when you're a bigger company. You have more plants, more security of supply, higher contract dollars issued by your customers because you're a more secure, more senior, more dependable producer. So all of these things come into play there. So I think that's where you'll see us going. In terms of the pricing, geez, that's too bad we're in the 90s. We were elated when we were in the 60s. Come on. Would we like to see 200? Well, sure we would, And will we someday? Yeah, probably so. I'm not sure what the other prices of inflation will be at the time. But clearly that we're in if you just look at it from a market perspective, we're in a correction and probably a much overdue correction, if that. Finally, the price had actually turned into the hockey stick move where it wasn't going up nice and orderly. It was going up, astronomically on a daily basis on virtually no volume, which was not a healthy market condition. We needed to cool off. Otherwise, you risk, the balloon that goes up and up and up until it bursts. And that's certainly not healthy for the market either. So I think we've seen a very, very positive correction in the equities. As is almost always the case in a relatively tight supply of companies or investment vehicles, such that we have in uranium, certainly in terms of viable ones, the moves both up and down are exaggerated when compared to the commodity price. So, we're quite happy with the market. We think it's a healthy market. We think it's a healthy reaction. We're very early on in the nuclear cycle. This is not a flash in the pan. This isn't you're in it for a year or two. It's obviously considerably longer than even the last one in people's memory, which may be the only one in most people's memory, the 04 to 08 time frame. But we've got decades ahead of us. I always like to draw akin to this as people say, what inning are we in? And I still tell them, really, in terms of the big picture, we're in the first inning still. You could argue that with this correction, it's the end of the first, we're going into the second. Irrelevant. It's an extremely long opportunity, and I view it much akin to if someone were to proposition someone with an oil and gas opportunity in the 40s or 50s. Not every year is up. Some years are horrendous. But by and large, it's been an incredibly dynamic growth story and well above most any other growth story during that time frame. And so I think that's something new to the resource investor, that they haven't seen the dawning of a new era like that in a long time, maybe in their lifetime. And to be at the forefront of that is truly exciting. And it's something that's going to, the biggest rewards will be, reaped by those that have the longest time horizon and the greatest amount of patience. You can trade this if you want to, but it's not for the faint of heart, trading the uranium market.
Well, I think most people would argue with you. It's not so easy doing any trading at the moment. it seems, uranium's been on leading from the front, as it were, and one of the very few things that people put their hands in their pockets for. So, and long may that continue. Just want to come back to a phrase which I pulled out of the boss presentation, which was this strategic partnership phrase, right? But you obviously done one deal now with them, and it's attractive in the sense that you're both builders and producers in terms of the team's experience and background. That's quite exciting. So me as an investor, I've got to take a view in terms of my portfolio, how much uranium do I want, and then what sort of blend of production, development, and exploration do I want in there? Again, I guess it's around that kind of supply component. It's like, how many new producers? There weren't that many last time around, the last cycle, before it all kind of, the lights went out in 2011. How many new producers do you think there are likely? How many are needed, quite frankly?
Well, like I said, I think you see maybe a room for 8 or 9 globally. In the U.S., you may see more than 2 for a while, but through consolidation, I think 2 is about the number in the U.S. Canada may be very similar to that number, maybe 3, I don't know. But, you aren't going to see them opening up like, mom and pop stores on the corner or Starbucks. It's not a franchise opportunity. It's a niche in the business, quite frankly. And so with that, you're going to see a much more moderate growth. And when someone's, if there is the one-off with substantial production, I think you're going to see, I think the phrase to rule the next decade in this business is eat or be eaten. It's really comes down to that. I mean, there's certainly economies of size and economies of operations, and I think you're going to see those.
Okay. Well, let's see how that plays out over the next few weeks and months. Like I say, it's a long way to go in this. Can we just come back? So I kind of, you did start talking about it, and I can remember I'd forgotten something. Let's talk about the rest of the portfolio and how you kind of bring that together. Now you've got the capital, now you've got the market behind you, and now you're meaningfully advanced in the sense that there's not a lot of competition in that space in terms of that development moving into production this year. How are you prioritizing what you look at and where you allocate this capital, and then what that does for the business?
Let me give you a couple of examples. Maybe be more meaningful than going through each project. And in our slide deck, there's a chart that shows the accretive nature of what we'll be able to do in terms of production timelines with this influx of cash. And it's you mentioned the strategic relationship and all that. We've done one transaction, but it's always nice to have a friend in the business. So, it's especially when they're, a big, capable friend that we like the way they do business. So, there's nothing else on the drawing board, but it's, obviously we have a good relationship to lean on. But in terms of enCore's immediate production projects, we've been talking about Rosita as being a satellite plant with, only moderate or even modest resources actually at the plant. In fact, the product we're running through now is a mile distant from the plant, but we're running it as a satellite just because of logistics on roads. It was cheaper to do it that way than it was to direct pipelines in a non-direct route. Once you look at that satellite wellfield development, which is what will fill Rosita, prior to this deal, we were going to have to take one of our projects, which was Upper Spring Creek, and there's 2 parts to that, but only one part, and move it forward. That would have brought us some production in hopefully late 25, maybe early 26, but about that time frame. Now, with the extra cash, we're able to concentrate on both halves of Upper Spring Creek, move both of them ahead in parallel, such that at that same timing, we're getting production out at 2 of them roughly, maybe 3 or 4 months apart, but it won't be having to work on something for a year and a half or 2 years, get it going, and then start the next one working on it for a year and a half or 2 years to get it going. Can work on them in tandem. And that is the real leverage factor of bringing in that cash, is that it won't make us do things one at a time. It will allow us to proceed on many of these satellite fields simultaneously or in tandem, such that we can ramp up that production considerably quicker at Rosita. And at the same time, we'll be looking at satellite opportunities to feed Alta Mesa, as well as I mentioned, they've got a 500,000 pound a year capacity for satellite feed, in addition to their primary 1.5 million pound feed. And the other idea that, or the other place that I can illustrate very quickly and tangibly the difference is the Dewey Burdock project in South Dakota. It lies 5 miles approximately. It's right up against the border of Wyoming. The roll fronts there that are mapped and known, if you travel to the northwest out of there, west and then northwest, those very same roll fronts that have the 17 million pounds Dewey Burdock have another deposit called Dewey Terrace that we own. It's a much smaller 2 million pound type thing. Wouldn't even quote a 43101 on it. Call that a geologic resource. But there's been virtually nothing done in between for I don't even know how long, maybe a decade or more. So we're able now to go in, and we had planned to put a few holes in, and by a few I mean a few, in the intervening space there to try and tie those together. Now we're going at it with a full-fledged program, and we'll be drilling hundreds of holes there, and with that and tying those two together, we think, given the old rule of thumb that you're going to have 500,000 to 1 million pounds of uranium per mile of roll front, we're quite optimistic that we can see the global Dewey project, not just Dewey Burdock and not just Dewey Terrace, combined into one, which we look at as the Dewey project, straddling the state line, which will give us more robust economics. It also gives us a bit of a playing card in terms of which side of the border do you really want to build your plant on. Obviously, there's huge permitting differences between the Wyoming side and the South Dakota side. And when it comes down to the state, because we are virtually through with the NRC permitting on the South Dakota side, but when it comes down to the actual state regulation and ruling on that, which you don't deal with the feds in Wyoming, but on South Dakota you certainly do. But when it comes down to the state, you do have a bit of a bargaining chip in terms of where would you like that tax base? Would you like it on the left side of the border or on the right side of the border? And it may not be the be-all, end-all, but it's certainly an advantage for us in that regard. So that's a project that you'll see significant gains moving forward as a result of this funding.
Can you talk to me about Texas for a little bit? Because obviously, I think your flagship projects are there. The ability to do business in terms of licensing and permitting, et cetera, and how it enables you compared to maybe some of the other states. I mean, you're in 4, 5 other states. What's Texas like? Texas is
it's not by mistake that we're there, and it's not by mistake that our first 3 years of production to meet our 3 million per annum run rate is focused entirely in Texas. It's obviously a very red state. It's obviously a very pro-energy state, and it's very much got an independent mind of its own sometimes. But that being said, you don't cut corners. You're just all about business. The regulators there, they don't over-regulate. They regulate the right amount. Like I said, everything's done by the book. There are no shortcuts. But there is an incentive on both sides to get to the same goal, which is not usually the case in a permitting regime. Permitting regimes are almost always us versus them. And they shouldn't be, because you're trying for a common good. And in Texas, that's realized. And so the regulators work hand in hand with the proponent and to get to that final goal. I mean, we were 20 months total from when we filed our amendment, which was a major amendment. That plant had last operated in 2008, I believe. So it was a major amendment after a major overhaul of the plant. And it was 20 months from when we put that permit in until the day we were producing. And I defy any other jurisdiction. I challenge any other jurisdiction out there to try and match those timelines. It's what it should have been. I mean, it was a very methodical, straightforward, and I commend the regulators. Certainly, put us through the ringer that we should have been put through to get where we were going. But it wasn't any wasted time on anyone's part, and it was a collaborative group effort to get to the goal line. And it's a whole lot better than an adversarial relationship. Quite frankly, we expect a very similar environment in Wyoming. They aren't nearly as well staffed, being a much smaller state, but nonetheless, we expect very similar results there. And those are the two states that are the premier ISR locales. And just for that fact is their permitting. They're both agreement states, which means you don't deal directly with the federal government. And that's a huge advantage. And there are other agreement states, but they don't typically have ISR amenable deposits.
Yeah, it's interesting. If I look at people like they're sitting on quite a few ISR assets in Wyoming. I mean, I guess, a little bit tied up at the moment, possibly a bond, quite a large bond on that. So yeah. So I'm just what I'm trying to work out is something you said at the beginning of this thing. There's lots of uranium, but not everyone's going to be able to get and produce uranium. So that means that people who can, people with the track record, experience, the team, the balance sheet, quite frankly, and the, I guess, current ability to get into production are gonna maybe. Do you think there's going to be more roll-ups, more M&A across the board? That's what a sense from you today.
Yeah, no, I think that's going to happen. I mean, you're obviously going to get more and more companies coming into the arena as well on the exploration side, what have you. And some of the very big holders that have been in the business forever, they may try and sell their assets. Like Cameco's package was on the block for quite some time, and once we crossed $75, it was pulled off the block immediately. Which is a significant price in their business plan from what they've said publicly, and I think that but you also see other of the big holders that will from time to time have a say on asset sale, and those might bring a new company out of the woodwork that comes in and leapfrogs into a position of a potential buyer. I think more likely it's one of the existing companies that stretches a bit to take one of these on. But you're definitely going to see, I think, at the end of the day, fewer producers, not necessarily right now, but you're going to see a relatively small number of the existing equities. I mean, I don't know what 150 equities now, something like that. It's hard to keep track of in the uranium field. Of those, like I said, I think you'll see 10 at the most, 8 or 9 new producers around the world, and for any given moment, you may see it go to 12 or something, but I think you'll see a continual evolution of buying out the companies that are small, new French companies to where you'll end up with that 8 or 9 when you look down the road here, probably in a decade or something.
Yeah, and again, I'm plugging into your North American access and experience here. Is like if I look at a lot of the narrative and the commentary out of the U.S. government has been very, very positive and supportive for the last, let's say, 2.5, 3 years, right? A few senators getting behind this thing and recognizing the during COVID that we suddenly hit this kind of energy crisis of our own making it, obviously. But not a lot of money, a bit of money, but not a lot of money. So the market's had to kind of sort itself out, and price and shortage of physical uranium has kind of solved that. Was that always going to be the case, or did you expect the U.S. government to sort of come charging up on a white horse and solve it for you?
Well, I think the problem really is in the fuel cycle, not so much in the uranium feed. I think the industry itself doesn't really need much help from the government or anybody else in terms of producing yellow cake. I mean, don't get us wrong. We applied and were actually the highest successful bidder in a Dutch auction to the DOE last year. So will we sell to the government? Will we take advantage of that? Sure. Do we need it? No, I don't think it's an integral need. It's a nice thing to have. But I tell you where we really need it, though, is in the conversion and enrichment. That is not a cheap game to get into on either hand. And yet that's where the bottleneck remains. That's where Russia's the 800-pound gorilla in the room. And here again, as you pointed out, we allowed that to happen. We were self-sufficient, and we've, offshored ourselves into almost total reliance upon foreign powers for that. So that's where you're going to need to see the billions and billions of dollars coming in. Sure, we hope they buy it. I mean, it also makes logical sense that the country has a stockpile if something as critical as uranium. We did for many, many decades. Last time during the 04 to 08 timeframe, they were selling that off to monetize it because who needed it anymore? Russia's our buddy. And so they sold off 8 million pounds a year, which helped keep the price down, which didn't help spur new production, et cetera, et cetera. And, then a number of other historical events came along to really, squelch it for the better part of a decade. But I think you're going to see a pretty fertile time here, as long as, clearly some of those endeavors are, I won't say they're beyond the realm of public finance or, private equity financing, but it certainly will go a lot quicker with public support. And here again, public permitting support. everything here has to be permitted. And if the NRC is not on side and if the federal government's not pushing it, it's just more delays. And I'm not talking about in the uranium industry. I'm talking about further downstream in the fuel cycle. But so far they've certainly been saying the right things. We've been seeing some significant cash go into that. So I'm optimistic that will go. Nonetheless, it's going to remain a bottleneck for a number of years at best.
Yeah, it's going to take not only a lot of money, but it's going to take a lot of time to get back in control. And I think that's should never have been allowed to happen in the first place. But there we are. And I'm sure we're going to have a great discussion about that one. But just to finish off on in terms of where the market is going, what do I as an investor look for and look at? I think that's of interest to me. So there's a few questions that have been thrown at us, and one of those is about, obviously, with uranium at heading towards the highs of 2010. Do groups like Sput, Yellowcake start dumping into the market, or do you feel that like they believe that the uranium price has got a long way to run, and therefore will be holding on to their stock?
Well, there's certainly a few that have uranium for sale at a certain price. There are a few hedge funds and that sort of thing. Sprut's a bit unique in that it doesn't really have a disposal method. It simply acquires. And they proposed a redemption factor for material in kind, which was a very interesting program. And quite frankly, wish they'd gone through with it. Would have seen their shareholder list full of nuclear utilities, I think, is a bit of a hedge against the source of last resort, which I thought was quite clever. But for whatever reason, they backed off of that. And as far as I know, they still have no means of disposition of their uranium. And so taking them aside is a bit of a unique case. There are several much smaller versions of Sprott out there that, quite frankly, aren't even necessarily advertising they're in the uranium, but private hedge funds. It takes some effort to become licensed to hold it in inventory. But nonetheless, we saw that before in the 04 to 08. In fact, much of the material that traded hands above $100 was hedge fund material. Will it cause, quote, the end of the day? Because I do agree that once one or two of them start dumping into the spot market, which they probably will because they aren't players in the contract market, although they could evolve to that. That would be healthy. But if they hit the spot market and it's not a charging, raging bull at the right time with the actual users needing a lot of it that particular month or two, when they hit the spot market, you could easily see a 20% correction in the spot market. It'll last about 15 seconds, so don't try and plan on getting in there. But it'll rebound as quickly as it falls. But during that momentary panic to get out the door with some of the hedge funds, you could see a pretty sharp correction. And of course, the equities will overreact, and everybody will panic, and this is the end of it, and no more. And like I say, it's a perfect whipsaw, is the word you used earlier. I think it'd be the perfect opportunity for that in the market, where they shake the tree and get the really last guys hanging on to give up and flee, and then it's over with before you know it. Off we go again on the upside. So my advice to the uranium investor is make sure you're buckled in and prepare for a long ride. It's going to be I think a very pleasant, buoyant experience by and large, and they'll probably try and scare the hell out of you a few times along the way.
Yeah, and I guess there's a few ways to play it. You're very keen to clearly get into production. You made all the moves about the past 3 years to ensure that you were in position to get into production. There are other development companies who, I don't know, perhaps aren't rushing to do that, and maybe they're looking at the market a different way from you, or maybe their business model is different from you. It doesn't mean I'm trying to work out who's right, or if there is a right or a wrong in terms of the those sort of two opposing strategies.
History will tell us. It's an easy question to answer in a rearview mirror, right? Our whole premise is not getting the top dollar for anything. Our whole premise is building a long-term profitable company. And so, our contracting is exposed some to spot, some to contract. Almost all of that, the contract has collars, that is floors and ceilings. We want to benefit, obviously, by a buoyant high price and an increasing price. But at the same time, we've got to be in business. And if we get a 6-month correction and there are no buyers in the market, which does happen in this industry on occasion, or it certainly has in the past, we don't want to be dependent upon that. We don't want to have, we want to establish a steady cash flow, predictable earnings with some margin to take advantage of that excitement in the market. And, will we be the top performer? We may well be the top performer in terms of the stock price, but, in terms of earnings, there will be periods where people are 100% spot that beat our earnings because they've taken care of the 100% exposure to that great rising market. But, that spot market's a double-edged sword at times. And, it looks like nothing but roses here. We've seen the price fall back $15 on no volume, just like it went up $15 on no volume. So you try pouring some volume on there and see what happens. Right now there's probably buyers out there just below the market to soak it up. But you get 2 or 3 guys selling at the same time. The market's not bulletproof. It's going to, when there's too much that comes on in too short a time frame, the price is going to go down. It may pop right back, and I think it will most of the time. But still, our view is, here again, it's almost going back to your question of the transaction is what did they want, and did they do better than you did and all that. We don't really care how well or poorly our competitors do. We're far more interested in what our shareholders are able to achieve and what they're, even more importantly, able to depend on. And that is a bit more of a consistent approach, a balanced approach to the pricing. Yeah, we're well aware of the bull market we're in. That's why we're in business. But at the same time, we don't want to, put all of our eggs in one basket, to use an old euphemism. But, a blended approach is the one that we've selected, we've taken, and we think makes a lot of sense. We've got a lot of folks in the industry that are on our staff that have seen the ups, the downs, the sideways, and every other permutation of the market over the years. And so isn't without considerable thought that we've developed this strategy, and one that we feel will work quite well for us and our shareholders.
Right. I hear you. And I think blended approach is a great phrase to go out on for investors. You need a blended approach in terms of your portfolio construction, and perhaps the weighting needs to be on the de-risk and not on the high risk, but each to their own. Bill, appreciate your time today. We will speak to you soon.
Thanks, Matt. You take care.